Hello and a very warm welcome to Trust TV, a show designed to give you unequivocal access to the mind of a professional investor and the thinking that drives their decision making. I'm your host, Marcus De Silva. The notion of an efficient market cannot be ignored, especially nowadays with instant news and information. So what do you know that the market doesn't, and therefore what is the best way to invest?
It's a good question. I mean, an efficient market hypothesis would state that the market sort of reflects all information in it immediately. And the kind of conclusion from this is that people might be better off owning index funds, which a lot of people do as at least part of their portfolios. But having said that, I have outperformed in the long run. I've outperformed since the trust by a significant amount since I started managing trust on 1st of July 1991. I don't outperform every year by any means, and I haven't achieved that. So I can point to that, and it is a sort of, I'd like to think it's a kind of tortoise rather than hare approach. And as we were really discussing earlier, I've kind of preserved capital relatively well in the falling markets. In a rising, raging bull market, I won't top the charts by any means, but I will make solid gains. So, I have a certain style, and I think, and there are other fund managers out there who have styles, and we can deliver in other areas which you can't get from a pure index, such as the investment trust structure, allowing us to provide the consistent dividend growth. So it's kind of horses for courses, but each fund manager is different, and I'm also helped enormously by the colleagues I work with and the company I'm with.
Is this a good time to get out of UK investment?
Well, it's if you're looking for income, it probably isn't. I mean, the dividend yield on the market is around 4% at the moment, and so if you were to sell and put it in the bank, you would suffer a big shortfall because bank deposit rates are not going to be much compared to that. So you've got a much better income. But I think I would always say about equities that they are volatile. Their shares move up and down, but they go up in the long run. And so anyone investing in the stock market should be doing it on a longer term perspective, in my view. Not, you get the great thing about the dividend there is the yield of the market is it gives you, you're paid while you wait during the difficult times when there's volatility. So if you focus on that and then just let the capital appreciation take care of itself over the long run. But I think anyone investing in shares should do so on a longer term perspective.
How do you try to keep the volatility low?
Well, I think we've talked about the diversified portfolio, but also the sort of companies I invest in. I think the fact that they're dividend paying means that in order to pay dividends, companies need to generate cash and profits, and they tend to be less volatile than the more speculative kind of companies that aren't making profits but might have sort of fancy prospects out there which may or may not get realized. So I think in general, looking at avoiding companies that are too highly indebted. I mean, certain industries, like very dependable industries like utilities, where people just pay their electricity or water bills, so they're much better suited to having a relatively high indebtedness. But when it's a cyclical company whose kind of demand for its products move up and down with the economic cycle, then certainly if they're loaded with a lot of debt in a downturn, they're going to be they're going to perform very badly. So I try and look at companies, really stick with good companies, good accounts, managements you can trust, and sound balance sheets. I would say that's a good formula for reducing volatility in a portfolio.
Joe, it's been really good to talk to you today. Thank you very much for coming in.